Hi class, I am back and I am getting ready to work for you E9A, which is a way that we can estimate what ending inventory and gross profit must be in or cost of goods sold must be in a situation where we haven't been keeping the details or we have had a fire. Now in the gross profit method, in E9A, they're using a fire as an example, okay? But in a company that uses the periodic method, this is what they would do every time they did a monthly financial statement in between the once or twice a year that they did a physical inventory count, okay? When you use the periodic method, as you know from Chapter 6, you don't even make any updates to inventory until you do a physical inventory count at the end of the year or maybe sometime in the middle of the year. So the gross profit method is the way that people estimate how to make their financial statements throughout the year. And in this case, it's how to estimate for insurance how much you think you lost when you had a fire. Okay. Start a fresh sheet for this one. Okay, so this is E9A. So the information tells us that he had some information, okay? So basically, when you know the model of how inventory works and the model of how cost of goods sold and gross margin work, you can take the little bits of information we've been given and you can back into the right answer, okay? So let's just list everything that he still has. He knows he has sales so far this year of $450,000. He knows he has purchases so far this year. And don't forget, these sales are at sales price. Purchases are at the company's cost of $280,000. Freight in, which as you know would be added to purchases to find the total of $13,700. Beginning inventory of $45,000. Then he tells us we have always priced, that the company has always priced their goods to achieve a gross margin of 40%. So gross margin %. Okay? Sorry, I thought someone wanted in this room. Okay, so the first thing I'm going to do, step 1, is I'm going to estimate cost of goods sold. And here's how I'm going to do it. If you tell me that your sales are $450,000, and you tell me that you like to have a gross margin of 40%, then guess what? I can estimate cost of goods sold. Don't forget, sales is always 100%. If gross margin is 40%, then cost of goods sold apparently is 60% of sales. So knowing what sales is and knowing that we want to have that we price to have a gross margin, which means that sales minus cost of goods sold leaves us with a number that is 40% of sales, then apparently cost of goods sold is 60% of sales. So I can actually just take 60% of the sales number and estimate what cost of goods sold must be. So, cost of goods sold, 60% of 450,000 would be 270,000. Now, step 2 says use that information and use the inventory flow model. In other words, you know this. Beginning inventory plus purchases minus cost of goods sold leaves you with ending inventory. This is the way the stuff comes into the inventory, goes out of the inventory. Okay, so let's drop in what we know. We know we have a beginning inventory of 445,000. We know we have purchases of 280,000 and freight in of 13,700. So I'll just do this. 280,000 and 13,700. Okay? We just estimated, I'm going to write estimated out here so we don't forget that we made this number up. We estimated this number. We just estimated cost of goods sold to be 270,000. So if I take 45,000, I add the purchases I know I made, I add the freight in, okay? I subtract my estimated cost of goods sold, I'm going to end up with an estimated ending inventory of 68,700. Okay? So if I can also subtotal up here and put in total cost of goods available for sale. You may be thinking I left that out. I don't always use it because I know how the flow is in my mind, but it would make it easier for us to do the math. So 338.7 total cost of goods available, beginning inventory plus purchases plus freight in, less cost of goods sold estimated, then we can find the estimated ending inventory, and that is the fire loss. That is the fire loss. And so he can give, the store owner, she can give this to her insurance adjuster, and they can figure out how to reimburse her from insurance, because they'll feel pretty confident about this number because she's got that track record of the 40% margin, and she had the records for purchases and sales. She just didn't have perpetual inventory records, so she just didn't know what her actual inventory was. Okay? That will get you started working problems. I would go ahead and try to work by yourself the ones that kind of match the ones that I've done for you. Check your work because I'm going to be posting the solutions so that you can start preparing for the quiz. And I will see you again next time. Thank you.